April 23, 1992. The State Bank of India. A routine internal audit reveals a sudden, unexplained shortfall of 5 billion rupees. The funds had vanished from the bank's books without a trace, triggering a panic that would alter the nation's financial system forever. The man at the center of the anomaly was Harshad Mehta. To the public, he was the Big Bull, a charismatic stockbroker who single-handedly drove the Bombay Stock Exchange into an unprecedented boom. Mehta lived in a 15,000-square-foot penthouse and owned a fleet of luxury cars. His visible wealth symbolized the financial optimism of a newly liberalized Indian economy. Beneath the opulence lay a massive, unregulated mechanism. Mehta did not build his fortune through standard market investments. Instead, he systematically exploited structural vulnerabilities within the commercial banking sector. The primary vehicle for the fraud was the Ready Forward deal, a short-term loan mechanism used by banks to maintain legally mandated cash reserve ratios. In these transactions, banks borrowed liquid cash from one another by pledging government securities as collateral. Because the system in 1992 was entirely manual, banks stopped moving physical bonds. Instead, selling banks issued a document known as a bank receipt, confirming the securities were held on behalf of the buyer. Mehta acted as a broker, connecting banks that needed cash with banks that held surplus funds. He convinced institutions to issue these bank receipts directly to him. This allowed him to intercept vast sums of capital meant for security trades and divert them directly into his personal stock brokerage account. By late 1991, the scheme evolved. Mehta required a higher volume of capital to sustain his market operations than legitimate deals could provide. To achieve this, he collaborated with small, corrupt financial institutions, most notably the Bank of Karad. According to subsequent central bank investigation reports, these institutions issued forged bank receipts backed by absolutely no underlying government securities. They were pieces of paper representing phantom assets. Mehta used these fraudulent documents as collateral to secure massive loans from major international and state-owned banks, including the National Housing Bank and ANZ Grindlays. The lending institutions accepted the forged receipts at face value, failing to verify whether the underlying securities existed. Once the capital entered Mehta's accounts, he deployed it aggressively into the stock market. He selected specific equities and bought them in massive quantities, artificially inflating their value. Shares of Associated Cement Company rose from 200 rupees to over 9,000 rupees in less than a year. The BSE Sensex index grew from 1,000 points in early 1991 to an unprecedented peak of 4,467 points in April 1992. The rapid rise created a powerful psychological feedback loop. Millions of ordinary citizens put their life savings into the market, believing the boom was a natural result of economic deregulation. What the public did not know was that the entire market expansion was floating on a multi-billion rupee cushion of stolen bank funds. Mehta was trapped in a continuous cycle. He had to constantly secure new, fraudulent bank loans to buy more stock, ensuring the market did not crash before he could return the older, borrowed funds. The architecture began to disintegrate on April 23, 1992, when journalist Sucheta Dalal published an investigative exposé in the Times of India. The report detailed how the State Bank of India was missing 5 billion rupees and directly connected the shortfall to Mehta's unauthorized access to government bond transactions. The revelation triggered an immediate structural collapse. The Bombay Stock Exchange plunged by over 40% in a matter of weeks, wiping out an estimated 100 billion rupees in market value. Millions of retail investors lost their entire financial holdings. The Indian government established a joint parliamentary committee alongside the Central Bureau of Investigation to trace the stolen money. Investigators uncovered a total systemic fraud valued at approximately 40 billion rupees, over $3 billion in modern value. The investigation revealed that the fraud was not limited to Mehta alone. The entire manual banking infrastructure was thoroughly compromised. Dozens of senior bank executives, fund managers, and brokers were implicated in accepting bribes, bypassing compliance protocols, and forging documentation.
In June 1992, the Central Bureau of Investigation arrested Harshad Mehta. He faced over 70 criminal charges, ranging from bank fraud and forgery to criminal conspiracy and tax evasion. The societal impact of the crash was devastating. The loss of capital crippled small businesses across India. Several ruined investors took their own lives as their savings evaporated. In July 1993, the scandal took a darker turn when the chairman of the National Housing Bank,
M.J. Firwani, died under highly stressful circumstances amid intense regulatory scrutiny. In 1997, Mehta made a highly controversial public claim, alleging he had paid a bribe of 10 million rupees to the Prime Minister of India, P.V. Narasimha Rao, to secure political protection. The Prime Minister firmly denied the allegations, and investigators found no definitive physical evidence to verify the claim. Mehta's legal battle lasted for nearly a decade. In 1999, the special court convicted him in a court case involving the diversion of corporate funds, sentencing him to 5 years in prison. On December 31, 2001, while still serving his sentence in Thane prison near Mumbai, Mehta complained of sudden chest pain. He was transferred to a local hospital, where he died of a cardiac arrest at the age of 47. The death of Harshad Mehta left numerous legal and financial questions permanently unanswered. At the time of his passing, more than 20 criminal cases against him remained completely unresolved. The 1992 scam forced a total overhaul of India's financial architecture. The manual paper receipt system was permanently abolished, replaced by fully digitized settlement systems and electronic depositories. Harshad Mehta demonstrated how easily an entire financial system could be manipulated through its own paper loopholes. He remains a historical study in how structural vulnerability, when met with calculated audacity, can create a multi-billion-dollar illusion that feels completely real right up until the moment it shatters.